All right, everybody. Ooh, this is a rough one. This is a rough one. I know you're already thinking these guys, and at this time with this market, yes. So we'll say this: no one can ever say we hid when the market wasn't doing well. We are here in the worst of it. We've been here for some of the best of it, and we're going to be here well into the future. This is what the market does. Now, we've had a perfect storm. We're talking semiconductor shortage. We have a war going on. We have two economies. The Chinese economy, well, manufacturing shut down in some of the Chinese markets, not all. And then you have some of the markets in pretty much all the markets in Ukraine have shut down. So this is amongst record inflationary environment, talking like you haven't seen the likes of this in 40 years. And people are scared. They don't know what's going on with their portfolios. The older generation who's getting ready to retire is probably feeling the brute force of this. But we're here. We're not hiding. We're not running. We're giving you all the best information we can. And for those of y'all who have listened to us, we were saying this back in November. Stop with the speculative stuff and let's buy some real stocks with a future. So with that being said, you still should be visiting your portfolio because even some of those are being tested right now. And Leon and I have said this before, and we say this again. Although we have said many of time we have an outlook 3, 5 to 10 years. We have also said, please, please, please hear this part. You still need to revisit your portfolio and make adjustments. Some of you all just think we were joking when we said that. It is not a joke. It's something we meant, and we hope that you all have taken heed. So we're going to dive into our topic today. Leon's going to tell you why we chose this topic, why I do a little bit of housekeeping.
Yeah, so as Brent said, today another tough day, and like he said, we still cheer, we still here, even though we suffered too. I mean, everybody who's in, unless you've been short this market, which means you profit when the market goes down, unless you've been doing that for the past 6 months, what 99% of people aren't doing because nobody saw this coming. Everyone is hurting. Like everyone's portfolio is hurting and has big losses. But as we've always said, and I actually inside our platform was just talking with some members. And, I posted again, just giving that perspective, a chart going back to the 1890s through, I think, 2010 or so, bottom left, upper right? With a bunch of dips in the middle, a bunch, the Great Depression, the Black Monday, 1987, the Iraq War, all that. All these things are huge dips. COVID, we all remember COVID, huge dip, came back. This one is definitely going to be a lot more elongated as far as the topsy-turviness of this market. Because we're seeing a change in, and this is not going to get wonky with it, but you have to understand this. The easy money policy we had with interest rates near zero for the last 15 years. Interest rates, so just quick history. Back in the great financial crisis of 2008, 2009, right prior to that, before the housing market crashed, interest rates were generally around 5%. 5%. Up until a month ago, interest rates were effectively zero to 2%, right? So rates were down. I mean, the rates were nowhere near what they were back in, let's say 1980, 2007. So we had 15 some odd years of just basically free money. If you went out and got a loan, your interest rate was 1, 2, 3%. For me, I trade on margin. My margin rate when I first opened my margin account 2 years ago, I think my rate was like just under 2%. It was like free money. It was almost like gambling money. So the market now is getting used to the fact that money is no longer free. People are not taking as big as gambles as they were before. And we're seeing it in the market. Money's being pulled out. Money's being sloshed around, going into bonds, going to money market funds. Just being some money's being pulled out of the market. Some money's being reallocated within the market from say speculative tech over like what they call cyclicals. Things that do well when the economy is doing well. So just a whole lot going on. But these are unprecedented times. As Brent just laid out, we have multiple, like 5 to 10 different things pounding this market every single day that the market has never seen before. And I heard a stat, I think last week, I believe this is the worst start. It's either the worst start or the second worst start, either for the S&P or the Nasdaq in history, right? So we're all part of history here, like something we really wanted. But I mean, that's just where we are, right? Not COVID wasn't even COVID didn't even start this bad, because remember, COVID didn't hit till March, and this actually started in November of last year, but they're counting from this year. So the worst, one of the worst start, if not the worst start in the history of markets. So that's where we're all going together. So just real quick recap. Inflation came out today. I posted last night in our community. Let's everyone keep their fingers crossed that the number shows that we're seeing inflation kind of ebbing and slowing. Not really the case, right? So inflation came out today. So there's a bit of good news here, but inflation came out today. The number came out from the CPI, Consumer Price Index, consumer prices, CPI. Yeah. Inflation was up 8.3% over last year. So the last 12 months, it's up 8.3%. So that's terrible news, because that's just, prices have gone up. The good news is that, so that was for April. In March, inflation was up 8.5%. So what does that mean? Over the last month, we've seen a 0.2% drop in year-over-year inflation. So while it doesn't sound like a lot, and we still have inflation up over 8% over the last year, we are seeing a slight slowing of inflation. And some people actually think inflation peaked in March. We don't know that yet. The data does show that month over month we have seen a slight drop in inflation. So that's a bit of good news. But again, inflation was still up 8.3% over the last year. So the market didn't like that. Today we were down, I think, anywhere from 2 to 3% again. And so what that means is that the Federal Reserve is going to stay on their war path to crush inflation. They told us we're going to do a 0.5% rate hike next month, and then the month after that. So we're still on track to do that. Some people say they may do a 75 basis point rate cut, or 0.75% rate cut one of these months. We don't know. If they do that, the market will hate that even more. So just be prepared. So having said all that, all of our portfolios have been crushed or being crushed. So what we're presenting today, I think we did last week or 2 weeks ago, are things that can possibly help your portfolio. We talked a couple of weeks ago about the I bond, which we hope a lot of you took advantage of. It's now paying, the I bond is paying 9 point, I think 9.
I think it's 9.25.
Yeah, 9.2. Yeah, not yet. So paying over 9% for the next 6 months, which is great, right? Your portfolio is taking a hit. Everyone's portfolio is taking a hit. It'd be nice to get that 9% over the next 6 months. So we have a way now. We're going to present today is a way to stay in the market and actually kind of benefit from these drops in the market. So what we're presenting today are what are called inverse ETFs, and there's 2 of them: one for the S&P 500 and one for the Nasdaq. And these are really cool, right? So the way they work is, and they only work. So as we said in the past, the market typically goes up, like we bottom left, upper right over time. That's what the market does. These are only really used in times like this, when the market is just some kind of a bear market or a correction, because what happens is as the market drops, these actually go up. So it's an inverse relationship to the actual market, and so it's the S&P 500 or the Nasdaq. So Brent, can you pull up a chart? Maybe like the Yahoo chart.
Yep. And just while I'm pulling up the chart for you all that maybe aren't familiar with ETFs, they're electronically traded funds, and they are similar to what old school mutual funds, more traditional mutual funds are, but they trade like stocks, where mutual funds have some limitations. These have less limitations, but they give you that diversity where a single stock wouldn't give it to you. So you don't have what's called single stock risk. And like Leon said, the inverse relationship to the market comes because exactly what Leon just said. I'm just reiterating. When the market goes up, these would technically go down. And now that the market is going down, these will go up. So it gives some balance to your portfolio.
Right. And so which one are you gonna pull first, Brian?
SH. Okay, if Yahoo Finance works with me, it says there is no chart. Okay, hold on.
Try
I will adjust.
If you want the 5 year,
1 year. Huh? You want the 5 year or 1 year?
No, just do can you do like the 6 month?
Let me see. Yep, I can do 6 months.
Yeah, 6 months. So the ticker symbol or the stock symbol for this one is SH. SH. And like I said, this is inverse to the S&P 500. So as we all know, like today, so the way this works is today, I think the market, let's say the S&P 500 was down 2%, right? And so what happened with this is, the cool thing with this is, if the S&P 500 is down 2%, this particular stock will be up 2%. So it's a mirror image of what the S&P 500 does. So again, S&P was down 2%, this will be up 2%. So we actually get benefits when the market drops with these particular ETFs.
And so, just so you all know, many of these are really designed to keep your account flat. They're not necessarily designed for you to put all your money in when times of, rough times come up in the market. It's not as if you just take all your money and dump it into this and hope that it keeps going up and up and up. Because if it is going up and up and up, that means the market's going down, down, down. And at some point, you're going to reach that peak where it's a buyer's market. And when the buyer's market comes, we've talked about this many times. If you just missed the 10 most explosive days in the market, it's the equivalent to missing like 3 years. No one knows when the buyer's market is coming back. They will speculate. People are somewhere at church saying they know everything about the market and they saw this coming for years. Everybody's going to claim to be an expert about knowing the market was going to crash after the market has crashed.
Right.
Like, you're going to hear people talking about, and I've heard it already. People saying, "Oh, I knew this was going to happen. I should have." Everybody's an expert after it happens. Leon and I have been in this thing in the thick of it with you all. And if you want to go back and listen to the tapes, we've explained that it was coming before it ever even hit. Not only that, we tried to give some warning to it. But let me tell you something else. And before we go into this chart, if you are a long-term investor, please go listen to our podcast from, was it last week or 2 weeks ago? Listen to like one of the last 3 podcasts we've done. You can go to IEApodcast.com, listen to it. Why am I saying this? Why is it important? You can also go to our YouTube page. If you look at the information that we presented, like during our live, we still showed that people who have had accounts that were like 5 years or older right now are still up tremendously in this down market, like tremendously. And so just don't think that everybody's account is going to zero. That's not what's happening right now. People are losing some of the gains who have been long-term investors, but you still have people out there who have made millions and millions in the market. They're giving back some of the profit, but at the same time, they're still up way beyond what they would be in a savings account. So for all you naysayers who are like, I knew this was going to happen, that's why I should have stayed in my savings account. It's still not a bright place to be. It feels good right now. You feel like a genius. You're whistling Dixie. Think you did the best thing ever. You're hearing everybody else's story, and your story isn't that. But if you look at people who've been in the market 5 years or more, it's still a horrible place to keep your money.
Yeah, what we did either last week or 2 weeks ago, for people that didn't see or hear, we actually we gave perspective, right? So we pulled up a bunch of stocks, or a few. I think we did 2 or 3 stocks, and we showed their 6-month return and we showed their 5-year return. One that sticks out of my mind was NVIDIA. NVIDIA. Over the last 6 months, I believe NVIDIA is down like 25%. But over the last 5 years, NVIDIA is up over 600%. And so that's what Brent's saying. Like, if you look at it like, oh, well, I'm a genius. I have my money sitting in savings account. I haven't gone through any of this. Yeah, that's true. Like you said, you probably feel good. But you've lost a lot of buying power over the last 5 years when people like us have made 600, 700, 800% on our money over the same time period. And what we always also try to, highlight is that this is a moment in time, right? Like this doesn't define the market. This isn't what the market is. This is a moment in time, and it hurts. We get it. Brent and I are going through it too, but we have long-term perspective. And as you said, right now, Brent and I, we're giving back. Anyone who's been in the market 3 to 5 years, right now, all they're doing is giving back profits, right? They're not giving back their principal. So yeah, instead of being up 300%, now they're up, 240%, right? They're down 60%, but they're still up huge. Right. So that's kind of the point about, again, long-term investing. So, okay. So the chart we have up here is of SH, symbol SH. And again, this is the inverse to the S&P 500. And the beauty of this, so I'm just going to kind of talk to the chart. So if you look at the people that can't see maybe on the audio, looking at a line chart of it. So we're looking at 2000, starting at 2022. It looks like, what was it at, Brent? To begin the year.
It was at $13.96.
Right, $13.96. And as we know, the year started off terrible, right? As soon as January hit, the market tanked. Well, this went from, in the beginning of the year, this went from 13 to, what is that, Brent? I think right about February.
Yeah, $16.07.
Right, so this was up, what is that, 30%?
No.
You said the beginning is what? 13?
13. Yeah, it's like 20%.
Okay, so this particular stock, SH, was up 20% in the month of January when the market was down roughly 20% in the same amount of time. So again, we're showing you that this is the inverse to the S&P 500. So as the S&P 500 drops, this will rise in value. So now we're going to go over, and then from about February to like the end of March, kind of went sideways, right? This particular stock kind of went sideways. Yeah. Then it dropped hard at the end of March because the market rallied. But now, since the beginning of April, the market has gone down terribly. And what does that begin with there, Brent?
Yeah, from the end of March, it was at $13.80.
So back to 13. And then as of today, SH is trading at about $16. So again, we're looking at another 20% gain, again, when the market is down roughly 17, 20%. So again, what we're showing you is that this helps cushion the blow when the market in general, or the market in general drops. This will rise because again, it's tracking the inverse of the S&P 500. If the S&P 500 is down 2%, this will be up 2%. If the S&P 500 is up 3%, down 3%, this will be up 3%. So it's the inverse of what the S&P 500 does. And as Brent kind of mentioned earlier, this is not so. If you're looking at this like, I found the holy grail, I found a way to protect my portfolio. Yes, this can help, but you do not want to dump all of your money or chase this thing and figure, okay, this is the way you're going to protect. You want to put some money into these, some money, because as Brent said, none of us know where the bottom is, right? So it could be tomorrow. Tomorrow, this thing could turn and rip, 10, 20% higher in a given day or a given week. And when that happens, this particular stock, SH, will drop in value. So this is just a way to kind of just give yourselves a little bit of peace of mind, a way to mitigate some losses in this type of environment. But by no means is this something that you want to dump, a ton of money in. It's just a way to help mitigate some losses. So that's
Also
SH.
too, with the investment like this, we also want to caution not even this investment, just with the mindset of some people right now who are running to fixed asset back to your savings accounts, whatever it may be. We just caution you. When this market rallies, and it will come, it's going to be fast, and it's going to be unpredictable because it's probably going to be a very large volume of false runs. And if you've been with Leon and I for any period of time, we talk about false. Leon called it. Leon called it like 2-3 days last week. I don't know when it was, but he called it like to the day. He said that tomorrow you're gonna see a rally, but this is not real. I mean,
that was after the Fed announced the rate hike. Yeah. Yes. The next day was a rally. Then the day after that, it was a complete bloodbath. But yeah.
Yeah, he said it. He was like, you might see a rally, but it's not going to be real. And why are we showing you all options, but then we keep talking about the market's not turning around? Because we don't want to lie to you all. But at the same time, we want to make sure that you're going into this from an educated standpoint. If you are a member of Investing Education Academy, you've heard us say time and time again, you should not be investing the money you need for bills, for your mortgage, for medicine. You should be using risk capital, curious money in some cases, we dry powder, whatever you want to call it. But we've always preached putting money away that wasn't an absolute necessity to you. Mm-hmm. Go ahead, Lee.
No, all this. I mean, it should be your investment dollars. It should not be money that you actually need. Risk capital that you can potentially lose, or at least take a big hit on. It should not be money that you need to pay bills, as Brent said, medical bills, things like that.
Be careful for those of you all who are at the bank thinking, I'm gonna put all my money in cash, and the tellers are going to do this. This sounds very familiar to some of you all. Oh, hi, Mr. and Mrs. X. It looks like you have a pretty reasonable size amount of money in your account. Have you thought about getting a CD or a bank instrument?
Mm.
And then it goes like this on your end. No, what is that? Oh, we have a way for you to get guaranteed returns in this really awful market. So why don't we bring you over to a desk and we'll tell you what some of the options are. You can get anywhere from 2 to 3 to maybe 4% right now. And then everybody goes, okay, yeah, sure. And we sign over a certain amount of money to these sometimes 12-month or more certificates of deposit, and we're stuck in them. Even when you're doing the treasury bills, notes, whatever it might be that we're talking about, you're like, where's this 9%? Just understand the term and understand too, some of these, if you were to liquidate the notes or bills before a 2-year period, I want to say there's some type of coupon rate that goes back to the company or back to treasury. So just understand there are rules to these things. And it's not like you just get this money and it's not locked up as liquid. It becomes illiquid until you move out of that note or CD or bill or whatever it might be. So, we're not going to go too deep into that right now, but I have heard the sentiment of people saying we're moving to these fixed income platforms for like 4%, 2%. And I mean, granted, the market is where it is right now, but think about it. The market went down this much, and pretty much like 2 months was the worst of it. How long do you think it will take for the market to reasonably start to turn around when that moment comes?
Yep. And also, like Brent said, a lot of these things you have to lock up your, and so just on that point, there's nothing wrong with going into CDs, going into treasuries. Nothing wrong with that, right?
I'm not a fan of CDs. That's
Yeah,
Leon. That's
yeah,
not
I know
Brent.
you Brent, yeah, full disclosure, Brent's not a fan. But at the same time, there's nothing wrong with that, right? There is some safety in that. There is, this market has been topsy-turvy, it's been crazy. If you want to take some money and lock it up into a CD that's paying you 2, 3, 4%, again, nothing wrong with that. You got to be able to sleep at night. But just know that, like Brent said, that money is going to be locked away for that period of time. And if we get at the back half of this year, if this market turns around and rips higher, you're going to miss out on some of that. So, I don't see anything wrong with putting in things like CDs or treasuries. Just know what you're doing, know what you're getting into, know that as Brent said, know the terms. But again, it's just another form of diversification. All right,
Yeah.
Brent, if you could pull up PSQ.
Yeah.
So,
And I agree with Leon. There's nothing wrong with it. I'm still not a fan, but I get it. And also, too, I am a fan depending on your suitability. So I'm not a fan of it for me. Some people are in a situation where every dollar counts. And for those reasons, I am a fan then. So I'm only not a fan in certain situations.
yeah,
What was the ticker, Leon?
P as in Paul, SQ. Yeah, so yeah, I agree. I think it all depends on the person's situation. So yeah, I agree with that. But all right, so PSQ. Now this is the same concept, except it's for the Nasdaq so the Nasdaq is made up mostly of tech stocks, and I know a lot of people in the IA community are heavily invested in technology. So PSQ might suit your portfolio better. It might be a better hedge, so to speak, for your portfolio if you have a lot of tech stocks. So it's the same exact concept. If the Nasdaq is down, say 3%, which the Nasdaq today was at one point was down over 3%. So here, perfect. So it's showing today that this PSQ was up 3.07%. The Nasdaq, if the actual Nasdaq itself was down right around 3% today. So again, it shows that it has the mirror inverse relationship to the Nasdaq. The Nasdaq is down 3%, like today it was. PSQ will be up 3%, as we just showed you as it was. So again, it looks similar to the last chart because these markets kind of move similarly. But like I said, for people that are heavily in tech, this might be a better play because this is going to mirror the inverse of the Nasdaq, which I know I'm heavy in quality tech stocks now. Versus make that point, quality tech stocks now, but they're still tech stocks. And so my portfolio more mirrors the Nasdaq than it does S&P 500. So anyone that's more heavily in tech, PSQ may be a better option for you to put a hedge on or kind of buffer your portfolio some. So just again, recap: these mirror the inverse of the indexes, the Nasdaq and S&P 500. If they're down, Nasdaq is down 3%. This will be up 3%. If S&P 500 is down 2%, SH, which we showed earlier, will be up 2%.
Yeah, where else have you seen this? I'm pretty sure this is the first time any of you all have heard about this or seen it. We can't make you do anything with this. We're just trying to provide you with information. We're not saying liquidate your accounts. This is not individual stock advice to any one person. We're simply giving you some options in this market because people always say, well, what can we do? So here's an option. There are many options. This is just one of them. So stick around with us. We'll be providing as many strategies, techniques, and outlets for our members, and this again, our non-members. We put everything we can into our podcast to bring you amazing information. So with that being said, we owe you two things today: two stock picks or cryptocurrency picks. We will be putting that information into our group, so you can go to Facebook and search Investing Education Academy. Again, go to Facebook and search Investing Education Academy, and you'll see one of our stock picks. If you are a member of Investing Education Academy, you can go to IAA members into our portal, and there's all kind of goodies in our portal. Oh, you know what? Gotta let announcement. We have a new sector. Can I say that?
Yeah.
We have a new expert who will be joining our team in a different sector than really Leon and I's space, to give some diversification to our community. As we solidify the relationship, this person is very well off, and they're going to be telling us, how they did it. We've been partners on some things in the past, and we know this individual very well. So look for new information. It's kind of, I know it's a little bit of ambiguity in what I'm saying, but that's on purpose. Stick around. We're growing. We're bringing new experts in, and we have a new line of business I think a lot of you all will be excited about. And for our community, it's going to mean a whole new level of education for you all. So definitely look forward to introducing and announcing it once we solidify the deal.
Yep.
All right. With that being said, thank you for joining us today. We will see you all next Wednesday. And next Wednesday, we may have a special guest joining us. I think you'll love it. So we look forward to seeing you next Wednesday. Tune in to see who